In this video, I'd like to demonstrate how to prepare journal entries using the net method. This is the discount net method for a company. So this will be the purchase side of the transactions, and then watch for a second video where I demonstrate the sales side. So for our company, we have Hammond Company purchased merchandise on account. So that means they did not pay for it straight up with cash. They charged it. So they purchased this merchandise on account from Zelda's Inc. for $80,000. Terms of the sale were, and you read these, I have them in blue for you here, 2% if paid within 10 days. Otherwise, the net is due in 30. These numbers could be anything. We could see 1% if paid within 15 days, net due EOM, which is end of the month, or any number of things. But the reading of it and understanding of it is the same. So we are first to prepare the journal entry to record the purchase on Hammond Company's books using the net method. So the net method again says that we are going to go ahead and take that discount and apply that. Most companies will actually try to take discounts that are offered to them if they can. And in fact, you can do a little research on this, but often they can actually go out and borrow money and pay back some interest and still come out much better to do that and be able to take the discount on the front side. So in accounting, a lot of times your software packages are already designed to take this discount and implement it for you. So we're going to kind of go in that direction as well. And then we will look at how you make or prepare the journal entries should the company not be able to take the discount. So for now, let's look at 2% discount. Okay, notice here on the right-hand side I have some calculations for you. We have the $80,000, which is the value of the merchandise that was purchased on account from Zelda. And we're going to multiply that by 2%, which is the amount of the discount, which turns out to be $1,600. So this is doing it in a two-step process. We multiply the $80,000, the full amount, times the discount. We get the amount of the discount that could be applied. And then step 2 is now we're going to take that, go back to the gross amount of $80,000, subtract the $1,600. The parentheses you see indicate a subtraction is about to take place. So you end up with $78,400. This is the amount that we are going to record the value of the inventory at, and we're going to record the amount that we owe Zelda's, an account payable for Hammond Company. A second way you can calculate this, if you realize that paying the full amount would be 100%, you can subtract the 2%, and that means that you will be paying 98% of that amount. And so this is what you see in the bottom, 80,000 times the 0.98. Notice that it's the exact same amount as we found when we did the two-step process above. So whichever way you're comfortable making this calculation, the amount will be the same. So the total we need to record then is $78,400. I'm just using Excel to type in the numbers. Remember, the inventory is a current asset. It increases with a debit to that account. And so we've at debit. The accounts payable. Now we owe some money to Zelda's. It increases with a credit to that account payable, which is a current liability. Okay, that is your journal entry 1. Number 2, prepare the journal entry to record payment of the invoice and assume that Hammond Company pays within the discount period. Okay, so we owe Zelda $78,400. We are paying within our 10-day, which was the period of time that was given to us with our credit terms above. So we're going to debit the accounts payable now, showing we paid this account. This will reduce the amount. And then we will credit the cash account, which is a reduction in the cash as well. Cash is an accounts as a current asset. It does reduce with a credit to that account. So all of our accounting matches up just like we expect it to. And then step 3. So let's assume now that the company, Hammond Company, does not pay within the discount period. What do we need to do here? Well, we're still going to remove that accounts payable that we have on the books at $78,400. But now we need to write a check back for the full $80,000. We did not earn the discount in this case, so we're going to have to send the check for the full $80,000. When you get these two parts in place, you see that you're out of balance because the total of the debit side must be equal to the total of the credit side, so we don't have that going on now. We are short $1,600, so let's plug that in. So what ends up happening is we will debit the inventory, and I'm just calling it merchandise inventory here, but we're going to increase the dollar value of that inventory because we did not purchase it with the discount at the discounted amount. So now we're going to need to add that back to the cost of our merchandise. So we will debit the merchandise inventory for that amount, and we're done with it. Now let's look at a few other what I call what ifs here. Okay, in this first what if, we're going to assume that some merchandise is needing to be returned for some reason. We're just not happy with it. Hammond Company is not happy with it, and so they're going to return it to Zelda's. So assuming first that now, the merchandise, which was originally valued at $10,000 and had been discounted at 2%. So if you look over on the right hand side, you'll see where I made these calculations. So we have them on the books at $9,800. So let's assume that we have that merchandise in the inventory. It's just they're damaged, they're the wrong color, something's wrong. But we've already paid for it as Hammond Company. Now we want to return that merchandise. So if the merchandise is returned after payment is made, then we should receive a cash payment of $9,800. Now it is possible that Zelda's would say, I'll cut you a check in a couple of weeks, so we might have an account receivable here. I'm going to assume that they've just cut us a check. Either way, we would have a current asset increase, either cash or accounts receivable. The amount of inventory would be decreased with a credit for that amount because we've sent some of that merchandise back. So this is how you would prepare the journal entry for merchandise that has been sent back after payment has been made. The second what if, merchandise valued at the same amount, discounted at 2%, is returned before the payment is made. So in this case, we still owed Zelda Incorporated some money. We owed them the full amount actually, but we're going to take this $9,800 off of the amount that we owe them, and we will do that with a debit to accounts payable. So this reduces the amount that we owed them. And it also still reduces the amount of inventory because we have shipped some of that inventory back. Now let's look at the journal entry to record payment of the invoice, assuming that Hammond Company did return $10,000 in merchandise, which had been discounted to $9,800 because of the 2% discount they were allowed to take, and pays within the discount period. So over on the right hand side you see that total. So this is your $80,000 minus 2%, which was $1,600, so $78,400 is what we recorded back at the very beginning. Let me scroll back up and show you. Remember, we recorded the full amount at $78,400. However, then some merchandise was returned, and you see that in the second item right there. So $9,800. This is still maintaining that discount. $10,000 times 2% would be $200. So minus the $200 leaves us $9,800. So now Hammond Company actually owes Zelda, and is carrying on the books that they owe Zelda, $68,600. So we will pay them by cutting a check, which is going to reduce cash with a credit to cash, and it is going to reduce the amount of accounts payable owed to Zelda's by the same amount. Let's look at a different scenario. Prepare the journal entry to record payment of the invoice, assuming Hammond Company returned $10,000 in merchandise, but they did not pay within the discount period. So now what do we need to do? Well, we are still carrying Zelda's on our records at $68,600. So we're going to debit that accounts payable. Then let me go to cash. So what kind of check is Zelda's expecting from us? Well, they're expecting, the full invoice was $80,000, but we did return $10,000 in merchandise. So they are fully expecting and entitled to a check for $70,000. Get debit and credit in here. I neglected to put that in before. There we go. And so merchandise inventory, I'm going to skip that. So we are going to need, in order to settle this debt in full, we're going to need to send a check to Zelda for $70,000. These spread out nicely. So that means we are out of balance. The total on the debit side must be equal to the total on the credit side, and that's not happening right now. So when you do the math, you 70,000 minus 68,600, you get a difference of $1,400. And when you're starting to think, oh, well, what about 1,600? Remember, we took a total of 1,600 initially. Well, remember, $200 was tied to that return that was sent back. So now we the amount that we need to satisfy this transaction and make sure that we are in balance is $1,400. So what does this do? This increases the amount of the merchandise inventory. The amount of cost that we have on our inventory is increased by this full amount now, this $1,400. Okay, let me talk to you about a couple of other items. When we begin to talk about merchandise, we talk about freight. FOB is often noted. This stands for free on board. You'll see free on board shipping point or free on board destination. When the allocation is FOB shipping point, that means that the buyer will pay the freight charges. So basically, the person shipping or the seller is going to probably pay it in advance with a separate invoice, and then they are going to add it to that invoice that they send out to the buyer. And note now, if they're entitled to some discount, this discount is usually only for the merchandise. It is not going to be added to the cost of it is not going to be discounted for that freight charge as well. So shipping point, the buyer will ultimately pay this fee and it will be added to the invoice, but the discount typically is not going to apply. And these items matter because this determines when title passes to the merchandise. So when is the insurance, whose insurance is going to cover it? When is it carried on the balance sheet, and whose balance sheet is it carried by? The other option is destination. For destination, that means the seller is actually going to cover the charges. They're not going to pass that on to the buyer directly. They're going to pay them initially. So the seller has a title or ownership until it actually reaches the destination. For shipping point, the seller gives up all of the risks and rewards that go along with ownership at the shipping point. So at the shipping point, the buyer takes ownership of those goods. One other item to mention to you is shrinkage. So when inventory physical count is taken or it becomes impaired, it's not valued, should not be valued or worth, fair market value is not what you are carrying it at or the company's carrying it at, then we need to write that inventory down. It needs to be done as soon as it is known and identified. The way that you do this is to debit the cost of the goods sold account, and then you're going to reduce the value by crediting the inventory account. So again, for inventory shrinkage, missing goods, impairment of the goods, something becomes obsolete or damaged, you write down that inventory for the value by debiting cost of the goods sold for the debit and credit your inventory account. Okay, this concludes your video for purchases.